one is so scary, man. I think the operating model, I thought it's one was it. This one, I mean, yeah, like I don't know how to start. You started? I did, but so the way I do it normally, I try it. Print out the structure and then I this time I didn't even think about print out, you know, just created the cells and yeah, made it empty. How do I where would I start?
Slides are all blank. I have no idea what's going on. Can you guys see my slides? You're just seeing a blank page. Okay, let's see how much I remember of my slides. All this is blank slides. Share the screen. Okay, on Zoom, if you can't see the slides, we can't see it either. So we're all on the same board. Okay. So if you have your slides, you can pull it up and you can remind me if I skip a slide, just let me know that I've skipped a slide. Okay. So last session, we were talking about the trade-off on debt versus equity. And if you remember the plus side, you have the debt has tax benefits. So if you have higher tax rate, you save on taxes and you've added discipline. For companies, at least where you're worried about managers taking bad projects, borrowing money forces them to stay disciplined. That's a plus side. On the minus side, the more you borrow, the greater the chances that you can go bankrupt. There's an expected bankruptcy cost. And there are two components to it. The probability that you will go bankrupt, which is a function of how volatile are your earnings. And the second is the cost of bankruptcy. If you remember, we broke it down into direct costs and indirect costs. Direct costs are what happens after you go bankrupt. Indirect costs are what you lead up to if people think you're going to go bankrupt. There's an agency cost, which is if lenders and equity investors have very different incentives. When you have two groups in the firm, you got to figure out how to balance them. And the way it shows up is it shows up as covenants and restrictions on you. And finally, when you borrow money, you lose flexibility. That's a trade-off. It's actually a very powerful way to think about how things play out in debt ratios. Let's take an example. We talked about how when tax rates change, companies are going to be encouraged to borrow less. Let's take another example. Let's assume that a company that is too large to fail faces distress. You know what I mean by too large to fail. The biggest company, it's the biggest employer. And the government steps in and decides to protect the company from bankruptcy. It does it with the best of reasons, right? It says, look, we're doing this because we don't want people to be laid off. We're doing this because we want to save the company. So it's just a one-off deal. We're going to save the company. That company can be saved, but tell me what happens to the incentives of companies from that day on. If the government steps in and bails out big companies when they get into trouble, what is it going to do to the debt ratios of big companies from that point on? Is it going to make them borrow more, borrow less, or is it going to have no effect? It's going to borrow more, and tell me why.
They know the government will bail them out of that.
In other words, when you borrow more as a big company, you get all the pluses of debt, but then when you get into trouble, the government steps in and says, we'll protect you. In Korea, this was the status quo in the 1990s. If you're a large Korean company, the Korean government basically acted as a co-guarantor of your loans, which effectively meant that banks would lend to the companies, not just based on their capacity to borrow money, but based on the fact that the government would step in. So what did every Korean company do? They went out and borrowed way more than they should have, which is completely rational, right? If I protect you from the downside of borrowing, you are going to borrow too much. But then when every company borrowed too much, it got to a point where the government stepped back and said, we can't bail out all these companies at the same time. And if you look at the Korean crisis in the late 90s, it was precipitated by companies having borrowed too much because the government gave them a green light. So when you see talk about bailing out companies in trouble, you always have to think about the consequences, how it changes the incentives from that day. Let's now talk about a very, very unique scenario. In fact, you guys seen The Twilight Zone? So it's one of my favorite shows. Let's say I put you in a Twilight Zone episode. And here's what the world looks like in this Twilight Zone episode. First, it's a world with no taxes. Nobody pays taxes. And as we're heading up to April 15th, some of you are probably saying, I'd like to be in that world, but you're not in that world. So you're in a world with no taxes. Second, this is a world where managers have the best interests of shareholders at heart. They take good projects, they reject bad projects. They're already disciplined. Third, no company ever goes bankrupt in this world. There's no default risk. Fourth, when equity investors go to borrow money from bankers, they tell the truth. They don't lie. They don't tell you that they're going to take safe projects and take risky projects. And finally, this is a world where every company knows its future investment and financing needs with certainty. Let me repeat, you have no taxes. Managers do the right thing. There's no company ever goes bankrupt. Equity investors never lie. And every company knows its future financing needs with certainty. Let me go to the trade-off and let's go item by item. What happens to the tax benefits of debt in this world? Zero, right? What about added discipline? If managers already do the right thing, that's zero too. You go to the other side of the ledger, there's expected bankruptcy costs, zero. No company ever goes bankrupt. There's no agency issue because equity investors don't lie. And every company knows its future investment needs with certainty. Who needs flexibility? Zero, 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 zero. So debt has no cost, debt has no benefits. In that world, how much should a company borrow? It can borrow zero, it can borrow $1 billion, right? I mean, borrowing money has no effect on your value. It has no cost, no benefits. Congratulations, you've derived corporate finance's most famous theorem. It's called the Miller-Modigliani theorem. You can spend 50 pages deriving the theorem, but you don't need to. In a world with no taxes, no bankruptcy costs, and no agency costs, it doesn't matter how much you borrow. At the start of this class, I told you that corporate finance was 64 years old. And I traced it back to a paper in 1958 by Merton Miller and Franco Modigliani. This was the paper that gave birth to corporate finance, the discipline. I remember when Merton Miller and Franco Modigliani won the Nobel Prize, a reporter asked Merton Miller to compress in one sentence what the research was that led to the Nobel Prize. Basically, because they wanted a headline. And the headline I saw on the paper the next day is Nobel Prize laureates claim it doesn't matter how much you borrow. That's how they summarized. And they're not the only ones. I know investment bankers who walk around using Miller-Modigliani. Every time you talk about debt, it's like garlic with a vampire. Miller-Modigliani, back off. Basically, they told us it doesn't matter how much you borrow. Why are we talking about debt and equity? They seem to forget the rest of the assumptions that Merton Miller and Franco Modigliani made to get to that conclusion. A world with no taxes, no default risk, and no agency costs. You're absolutely right. It doesn't matter how much you borrow. Just to show you how absurd people push these findings to. The early 90s, I ran into somebody who'd been a student in this class in 1986, went to work for an LBO fund. In fact, it was a fund that did the leverage buyout of Federated, which is a parent company for Bloomingdale's. This crazy Canadian investor, and I'm not using the word crazy as an insult, he was actually mentally unstable. A guy called Robert Campbell took over Federated, borrowed a huge amount of money, and this LBO outfit had funded some of that deal. I remember, if you think about it, buying Bloomingdale, which is a specialty retailer, at the peak of its price, it blew up. It took the LBO outfit down with it. The LBO outfit went kaput. So a few years later, I ran into this guy and asked him what he's been doing. And he says, he worked at this LBO outfit. So I said, why would you guys borrow that much money to take over Bloomingdale? That doesn't make any sense. You know what he said? Don't you remember Miller-Modigliani? I said, I do. And I'm glad you live in a world with no taxes, no agency costs, and no default risk. And remind me again what happened to the outfit you used to work for. Without a trace of irony, he said, it went bankrupt. You see the irony here? You're talking about Miller-Modigliani, and Miller-Modigliani is based on the premise that nobody goes bankrupt. And the same sentence, you're saying, the outfit I used to work for went bankrupt. So let's set this on the table. In a world with taxes, with default risk, and with agency costs, which is the world that I live in, and I think we all live in, it does matter how much you borrow. Can you borrow too much? Of course you can borrow too much and get into trouble. Can you borrow too little? I think you can if there are tax benefits from debt. So let's get rid of this notion that Miller-Modigliani told us it doesn't matter how much you borrow, and use that as an excuse for borrowing as much as we want. Now, before we actually look at ways in which we can come up with this optimal mix of debt and equity, because this trade-off is a little fuzzy, right? If I asked you, should you borrow 30% or 50% or 70%, you can't give an answer. I want to talk about one final thing before we embark on that mission.
I put in the recycle.
If your mic is on in Zoom, could you mute it? So let's talk about what's called the financing hierarchy. What is the financing hierarchy? This is on page, I think, 20. We're on page 30 of our slides, if you have the slide. Is that the right slide? Okay, 31. Yeah, 31. If you turn to page 31, so in the Miller-Modigliani world, it doesn't matter how much you borrow because there are no taxes, no default risk, no agency costs. But if you turn to page 31, this is the result of a survey that was done where managers and CFOs were asked, if you had a choice on where to raise money, what would be your best choice, your second best choice, if companies had a choice of financing? Take a look at that list. Notice what's on top of the list. Retained earnings. If you had a choice as a company, the place you would go to fund that project is with retained earnings. Next on the list is straight debt, basically debt with no special features to it. Then you get convertible debt and preferred stock. And we keep going. At the very bottom of the list, you have convertible preferred stock. It's called a financing hierarchy. I'm not saying it's good or bad, but given a choice, managers seem to go with, if they would like to raise all the capital they need from retained earnings. And let's think about why. There are two things managers value. One is flexibility. Flexibility in what sense? Being able to change their minds. And second is they don't want to be accountable. They don't want to answer somebody's questions. See, the nice thing about using retained earnings, the way the world is set up is if you use retained earnings, you don't have to explain to somebody why you use retained earnings. There might be a stockholder who gets up and says, why don't you pay more dividends? But that's an easy question to deal with. But if you issue new equity or new debt, you got to put out a prospectus with new equity, and a banker asks you questions in new debt. So if you think about flexibility, maximum flexibility and the least accountability, retained earnings comes first. Microsoft went public in 1986, right? Tiny company then. Now it's a what, $2.5 billion company. You know how much new equity Microsoft has issued since 1986? So when they went public, they did an offering, they raised equity. Since that initial public offering, Microsoft has never, ever gone back to the market to raise fresh equity. They might issue a few shares to cover option exercises, but this is a company that has never used new equity. That doesn't mean they haven't used equity. They've still used a lot of retained earnings to build up. But that's a financing hierarchy. It reflects the fact that managers like flexibility and they don't like to answer questions about what they're going to do with the money. You think, so what? If you get a chance, get on to the Wall Street Journal or any financial newspaper, and you'll see tombstone ads. You know what tombstone ads are? So when a company puts up and says, we're raising $6.5 billion, it's raised an announcement of how a company raising capital. And below it, there'll be a list of investment banks who've lined up. Find a couple of tombstone ads. Let's suppose you find a tombstone ad for a company that says it's going to issue convertible preferred in the next few months. You don't know, and you've never heard of the company. All you see is they're issuing convertible preferred. And I ask you, what kind of company do you think it is? Is it a healthy company? Is it an unhealthy company? Given the fact that it's issuing convertible preferred, what can you tell me about the company?
It could be maybe like a high risk.
Probably desperation, right? You're scraping the bottom of the barrel. It's desperation. If you don't believe me, take a look. If healthy companies will issue straight debt, if you're going to raise capital. New equity is actually less preferred than new debt. Then comes, so basically you can see the hierarchy play out. You tell me how a company is raising money, I can guess how healthy or unhealthy that company is. Yes.
Isn't that true for public companies only? Like for a massive company, right? When a company is young, that might change. Could it
Well,
not?
even for a young company, why do you issue convertible preferred? A lot of young companies do. Why do they issue convertible preferred? Because debt has no tax advantages. And who's going to lend money to a young, would you lend money to a young growth company just as debt? I mean, any banker who lends to a young growth company with a traditional bond should have his head examined or her head examined. And here's why. You have a contractual payment, right? And this is a young company. You don't get any upside. If I were a banker lending to a young company, I definitely need a piece of the equity. The only problem is you're saying, why convertible preferred versus convertible debt? For a young company, if you're losing money, the difference between the two in terms of tax benefits is non-existent. In fact, convertible preferred at most young companies is almost all conversion option and very little preferred. Just another way of raising equity. So I think this is true for any company, private or public. The problem with private companies is your choice is narrow. Because how do you raise fresh equity? You have to come up with the equity yourself and you might not have it. So their desperation might drive you to do something you don't want to do. But if you have choices, clearly you're going to see it play out in what you choose to use. Any other questions? So now let's talk about the different ways in which you can come up with the right mix of debt and equity for your company. I'm going to go through 5 approaches. The first approach is what I'm going to spend the most time on, in fact, the rest of today on, but then I'm going to talk about refining that. So first approach you're going to be very familiar with. You know what I'm going to use as my metric for coming up with the optimal mix of debt and equity? I'm going to look at your cost of capital. I don't know how far along you're in your project, but I'm far along in my project. I know what the cost of capital is for Disney. I know the existing mix is 88% equity, 12% debt. So the first approach, I'm going to use the cost of capital to optimize my debt ratio. Then I'm going to talk about the limitations of that approach and kind of refine that approach to try to fix those limitations. Let's call it the enhanced cost of capital approach. Then I'm going to talk about an approach that was developed at the University of Chicago that bankers and LBOs love, called the APV approach. They screw it up big time, but they use it all the time. We'll talk about what it is that makes the APV approach so attractive to bankers. And then I'm going to talk about the way most companies decide how much to borrow. You know how most companies decide how much to borrow? They don't optimize cost of capital. They don't use the APV approach. They just look at what everybody else in the sector is doing and they try to stay as close as they can to the norms. I'll talk about what it is that draws people to this. I call this Me Tooism, corporate finance, where if you ask people, why are you doing this? It's basically a Me Too response because everybody else is doing it. So with each of these approaches, we're going to get closer to actually coming up with an answer. When somebody says, what is my optimal debt ratio? Your answer is not a lot of debt. I mean, that's not enough. You can actually come up with something that says 40% debt. It's not precise, roughly 40% debt for your company, or roughly 10% debt for your company. We'll talk about why it varies across companies. So let's go back and revisit the cost of capital. I have a paper that I sent you the link on where I call the cost of capital the Swiss Army knife of finance, because it plays roles in almost every aspect of finance. In investment analysis, what does the cost of capital become? What do we call it? It was a hurdle rate, right? You needed to make that. In capital structure, it becomes an optimizing tool. We can use it to decide the right mix of debt and equity. In dividend policy, I call it my divining rod. So if you ask me, should I return a lot of cash to your companies, you need to make more than your cost of capital to reinvest. So it becomes a divining rod. In valuation, it becomes the discount rate used to actually value the company. So let's go back and very quickly review how we measured cost of capital. The cost of equity came from looking at the risk in the company through the eyes of the investors in the company. The reason I emphasize that is we measured the cost of equity using a beta. And if you don't like betas, a multiple beta, basically the view was if your investors are diversified, the only risk they care about is the risk they cannot diversify away, and the cost of equity reflected that. And it's a levered beta because if you borrow money, that equity becomes riskier. The cost of debt, we said, is the rate at which you can borrow money long-term today. The cost of capital is a weighted average of your cost of equity and your cost of debt. That was a hurdle rate, but that reflects the existing mix of debt and equity. So here's the way the cost of capital can be used to optimize your debt ratio. If I change my debt ratio, will my cost of capital change? It's an easy question, will it? In the Miller-Modigliani world, it will never change. That's one of the features of the Miller-Modigliani theorem is as your debt ratio changes, your cost of capital will be a flat line. Why? Because whatever you gain by using debt, you will lose on the equity side, everything will even out. But in the real world, the cost of capital will change. Let me ask you a follow-up question, it's a little tougher. Will my cost of capital go up or down as I add debt? And what's your rationale for that?
Well, because debt is usually cheaper. And
Okay, so now we're on to, so debt is you, but if I carry this to its logical extreme, I'm going to end up in a very dangerous place, right? Because the cost of debt will always be lower than the cost of equity. So if I use the argument that debt is cheaper than equity, I'm going to keep borrowing and borrowing and borrowing into bankruptcy. So what's the trade-off here? Because something must offset that cheapness effect. So when I borrow money, I'm replacing more expensive equity with cheaper debt. That's good, right? So what's the bad side? As I borrow money, what's happening to my cost of equity and my cost of debt? Let's take the cost of equity. Cost of equity will go up and the cost of debt will go up. Do you see where the trade-off arises? When I replace more expensive equity with cheaper debt, both the cost of equity and the cost of debt will go up. Why will the cost of equity go up? It's a levered beta. So if I use more debt, my levered beta will increase. And this is, again, a reason not to use regression betas where you freeze the beta into space, because then you get this delusion that you're borrowing money and making the cost of capital go down. So if you're being realistic, the cost of equity will increase. Why is the cost of debt being affected by my borrowing more money?
you're getting riskier, so the next lender is going to want higher interest rates.
In other words, you're a banker and I tell you that I'm going to borrow more money. You're not going to lend money at the same rate you used to. You're saying you're doubling your debt. You've become riskier. And if I wanted to make it explicit, I can try to capture that in how much default risk there is. So both my cost of equity and my, so now we can make a general statement. If the effect of replacing more expensive equity with cheaper debt is greater than what I lose when both numbers go up, I should borrow money. But if that's not true, I shouldn't. So I've kind of laid the foundations for how to use the cost of capital to optimize the debt ratio. Here's what I need to do. I need to compute what your cost of capital will be, not just at your current debt ratio, but every debt ratio from 0% to 90%. You know why I stop at 90%? Because a company can never, ever be 100% debt. And here's why. What's the definition of equity? You're the residual risk bearer, right? So if there's nobody left to bear the risk, guess what happens to lenders? They all become equity investors. If the last equity guy leaves the room, every lender has now become an equity investor. So I'm going to stop at 90%. So let me start with a hypothetical example. This example is, let's see, how many years old? 43 years old. It's, I don't know which table this is. It's a whole table of cost of equity and cost of debt. So if we go to the next, I remember the corporate finance professor I had in my first corporate finance class came in with this table. He said, today we're going to talk about the optimal debt ratio for XYZ widget company. I've never understood this fixation with widget companies when you got real companies out there making all these real things. I think the nice thing about widget companies for professors is you can't contest whatever number gets used because you have no idea whether widgets are discretionary or non-discretionary, what people use it for. But he talked about XYZ widget company and he put up this table that you see on whatever page. Now, what page is it on? 32, 33, something like that. There's a table with cost of equity, cost of debt. So basically, with each column, he gave us the reason why things were happening the way they were. So if you look at the table, it goes from 0% to, I guess, 90% debt. And what page is that? on page 40 for each, for each debt. And he said, and he gave a good story. He said, as the debt ratio goes up, the cost of equity will go up because equity becomes riskier in a business as you borrow more money. Makes sense, right? The guy in the first row, wasn't me, put up his hand. And he said, but why is it going up the way it is? Because you take a look at the table, it looks very suspicious. It goes from 10 to 10.5%, 10.5 to 11.1%. Honestly, it looks like he just made up the numbers. His response was, don't worry about that. It's the principle that matters. I said, okay. Then he went to the cost of debt. And as you borrow more money, your cost of debt will go up because lenders will find you more risky. And again, the same guy in the front row puts up his hand and said, but why is it going up the way it is? And again, the answer was, it's just the principle that matters. Let's move on. And he kept moving. And if you look at the second to last column, he has the cost of capital for the company at every debt ratio. And what do you notice? Initially, as you borrow money, your cost of capital goes down. I think it gets lowest at a 40% debt ratio, and then it goes up. He said the optimal debt ratio for this company is 40%. And to kind of reinforce that notion, he showed us what would happen to the value of the company if the so if your cost of capital is minimized, if the value of the company is the present value of the cash flows, you're maximizing your firm value. And isn't that the end game in corporate finance in the first place? He thought mission accomplished. But there was a lot of skepticism because the numbers all look made up. Because if you think about it, how many points on this table do you have for your company when you finished analyzing the cost of capital of your company? The 1 point, which is at the existing debt ratio or the cost. You don't have a table, you have a point. If I had this table for every company, why do I need a corporate finance class? I can look up the lowest number. Anybody can, a 10-year-old could look it up. So the questions were really about estimation. How do we come up with these costs of equity, costs of debt? Because they basically look made up with a real company. How would we do that? He must have thought we were just dumb. Because he said, if you guys don't get it, I'm going to show it to you in a different way. So if you turn to the next page, he showed us a graph of the cost of capital at different debt ratios. And he said, do you see where the optimal is? It's the low point on the graph. He was completely missing the point. We understood that. The question we were asking is, how do we get this graph for a real company? Because if I can do this for a real company, we're home free, right? If I can show you a cost of capital graph for Disney that resembles this graph, you can do it then. Use the same approach. So I remember coming out of this class and I need to be able to estimate these costs of equity. I looked in every book, there's nothing there with the case studies, but there was nobody, in a sense, fleshing out. And I said, it can't be that difficult. And in many ways, the way I've approached cost of equity and cost of debt reflect that search I had, because I wanted a cost of equity that was dynamic, which I could adjust for the debt ratio. That's a whole fixation I had about levered, which drove you crazy on the quizzes. What's this thing about levered and unlevered betas? That then gives me the capacity to estimate the cost of equity at different debt ratios. So let me lay out what I'm going to do. I'm going to start off nailing the 1 point I should get, which is the existing cost of capital. And if you're keeping at the project, you've got that number too. Next, I'm going to estimate the cost of equity at every debt ratio. This is going to be the easy half of the equation. How am I going to do that? If I have the unlevered beta, at every debt ratio, I'm going to compute the levered beta. I'm going to come up with the cost of equity. I'm going to come up with cost of equity from 0 to 90%. The cost of debt is trickier though. For most of you, especially for those of you at companies that were rated by S&P or Moody's, what did you use for the cost of debt? It's the rating of the company, right? Triple B, AA. Wouldn't it be nice if you could just send this table to S&P and ask them to give you what the ratings would be for your company at every debt ratio? I tried that the first time around. Somebody worked at S&P. He said, can you fill it? And his response was, do it and then we'll tell you. S&P is not going to telegraph ratings at hypothetical debt ratios. But we have a way around that, right? For a company without a rating, how do we get the cost of debt? We looked at an interest coverage ratio to get a synthetic rating. Remember that? Now let's assume that I keep the operating income fixed, and I'll tell you how we managed to do that. And I borrow more money. What's going to happen to my interest expenses? They're going to go up. As my interest expenses go up, my coverage ratio is going to decrease. As my coverage ratio decreases, I can look up the synthetic rating at that interest coverage ratio. And as I borrow more money, guess what's going to happen to my rating? It's going to go from whatever, AAA all the way down to C. And once I have that synthetic rating, I can get a cost of debt. And I can create a table that looks exactly like that XYZ widget company for any company that you give me. So let's try this on Disney. As I said, the first step in this process is estimating the current cost of capital for Disney. We've already done that because we did that as a hurdle rate. I think the mix of debt and equity we came up with was 88% equity, 12% debt. Now, part of the question you might have had when I did that is, why 12%? Why not 20? Why? Because it looks like they had too little debt, right? The debt was really cheap relative to the equity. The way we got the cost of equity is we started with an unlevered beta for Disney of 1.0. I don't even remember what it was, 0.92. That we applied the debt to equity ratio to come up with a levered beta. And for the cost of debt, we use the actual rating. So the cost of capital reflects the existing mix. That's my starting point. I know what the current cost of capital is and the existing debt ratio. One way to frame what I'm going to try to do is I'm asking, would Disney's cost of capital be lower at a different debt ratio? In fact, that's a question each of you should be asking about your company. You have an existing debt ratio. It could be 100% equity for all I know. Will this company benefit by borrowing money? So let me lay the groundwork for doing this. Before I jump into the tables, the first thing I took a look at was Disney's income statement. You know what I wanted to see? For the interest coverage ratio, what do I need to see? How much operating income does Disney have? So I'm looking at the existing income statement to see my capacity to borrow money. In fact, let me take a pause there. If I look at the income statement, I see a negative operating income. My job just got really easy. If a company has negative operating income with no light at the end of the tunnel, what's the optimal debt ratio for this company? It should be 0. There's nothing more to discuss. There's no what if. If you have negative, you might choose to borrow money because you have no other choice. But if you have negative operating income, the game is done. That's part of the reason that I asked you to pick a company that has at least some operating income, right? Because otherwise, this part of the analysis, you're done. Optimal debt ratio is 0%.
Professor, I have a question.
Go ahead.
So I picked Boeing, and Boeing used to have positive operating income until a couple of years ago. So
let's take a pause there. Why is Boeing losing money? Let's dig at the 2 reasons why Boeing is losing money.
Because of the pandemic, and then obviously the 737 MAX issue that they had.
So here's my follow-up question. Do you think after the pandemic, airlines will go back to buying aircraft?
Yeah, absolutely.
Okay. So that's the first part. The pandemic part, you assume will pass because ultimately you have only 2 places to go buy your aircraft. One is Airbus, the other is Boeing. The Boeing 737 MAX is more troublesome, right? Because that's a self-inflicted wound. And if this were a company in a much more competitive business, it could have been a fatal wound. What's going to bail Boeing out is, again, there are only 2 players in this game. So I think Boeing will survive. The pandemic will pass. So the kind of long-winded answer I'm giving to you is, when you look at the operating income that you're going to borrow money against, it's not last year's operating income. It's what you think the company will make as operating income in the future.
Okay,
Boeing, yeah, go ahead.
That makes a lot of sense. I can just look at like the equity analyst projections and basically use that income.
Or you can look at history. If you don't trust equity analysts, remember equity analysts project out earnings per share and net income. They don't do operating income. So you might look back at the last 5, 10 years, look at what the operating margin is. You have to make a judgment call. And if your judgment is they're never going to get back to making money for the next 5 or 7 years, guess what? The right debt ratio for Boeing is in fact 0%, unless the government bails them out. So this is, yeah, go ahead.
No, thanks a lot. That makes a lot of sense because I think they will make money in a couple of years. Thank you.
In general, though, when you look at your company, look at last year's operating income. And if 2020 effects are still there, you might have negative operating income. Don't base your optimal debt ratio on just on that number. You have to make a judgment call on what that number will look like in the future. I think for Disney, what did I have as operating income? 10 billion? Somewhere around, after adjusting for leases. The EBIT that I have in that table?
9.45.
With the lease adjustment, it's, I think, a little higher, right?
Oh, 10.
10 billion. So let's file that away. Boeing, in this case, Disney has $10 billion in operating income. That's good, right? Because that means you can service what, 2 billion in debt, 2.5 billion in debt comfortably. You clearly don't want to borrow money to get to 9 billion in interest expenses, because that'll put you very close to the edge. So they have a lot of operating income. On the following page, I also look at the unlevered beta. Why do I look at the unlevered beta? Because I want to look at how risky your core business is. Let's say when you do this for your company, you see an unlevered beta of 3. That's a red flag, right? Because when you borrow money, what's going to happen? That unlevered beta is going to get magnified. If you see an unlevered beta of 0.3, that's good news for borrowing. Remember, we talked about power companies and regulated utilities. If you look at their unlevered betas, they're tiny because their core business is incredibly safe. So when they borrow money, the effect of that borrowing is much lower. So first stop is check to see how much money your company is making, because that's going to allow them to service debt. Second stop is I check the unlevered beta. So now I have, yeah, go ahead. No, continue.
Just something that came in here right now was, we mentioned earlier, like maybe like 5 minutes ago, that the cost of debt is always cheaper than the cost of equity.
Yeah.
But then something that I thought about was like, if you're a tech firm, right, at the dot-com boom, wouldn't it make, or even like 2 years ago or last
Your true cost of equity was still higher than the cost of debt. The fact that people are willing to pay high prices meant that they were paying too much. But if you don't deliver that, and they weren't buying expecting to make 6% returns, right? So even at the peak of the tech boom, people buying Amazon were expecting to make 25%. It was completely unrealistic. But then that's what caused the dot-com bust, is eventually these expectations were set so high that when they delivered only 11%, it wasn't good enough. So the cost of equity, simply because of the fact that the last guy in line, is almost always higher than the cost of debt. There's one exception. It's a great quiz question, interview question for those of you once you get to the other side of the interviewing process. So reserve this question for that arrogant jackass who thinks he knows everything. So you're at the Harvard Business School, the MBA sitting across the table. Ask him, is it possible in a company for the cost of debt to be higher than the cost of equity? They told you there's one exception. There's one group of companies where this can happen. And there's a logical follow-up to why it happens. When can a company's cost of equity be lower than the cost of debt? You mean lay the groundwork? Yeah, good.
Is it like right before bankruptcy?
Well, even then, if you're the cost of, you're buying equity in a very troubled company, your cost of equity is going to be 40, 50, 60%, right? Right before bankruptcy, your debt to equity ratio is 900%.
If they're trading at very high multiples,
If I'm what?
if the company is trading at very high multiples,
Yeah, but again, that's the earlier response to the question. The fact that you're trading at a high multiple doesn't make your cost of equity low, because those people buying your shares are not accepting a low rate of return. They want a high rate of return. They're being unrealistic about it. But nobody buying Palantir is saying, I'll settle for a 4% return or 5%. They might be pricing in only 4 or 5%, but that's their problem. Their expectations are still much higher.
I was thinking from the perspective of like acquisition, because then, you like take the reciprocal of that versus, cost
Don't
using
do
debt.
that. The earnings to price ratio is a terrible measure of the cost of equity, especially for young companies. So I know people use that for mature companies, but it doesn't work for young companies.
Thank you.
You had an example? Let me give you the foundation though. What did I say the cost of, how do we measure risk in the cost of equity? Risk you cannot diversify away, right? We started with an unlevered beta. And what goes in the cost of debt? Default risk. Remember we talked about businesses which have very low systematic or non-diversifiable risk. But their business actually is risky, but most of the risk is firm specific. Remember gold mining companies? No? Gold itself is like gold mining companies, if you think about it, are risky because gold prices move, but because gold prices move in the opposite direction of the rest of the market, we talked about how gold can have a very low or even a negative beta. Let's say you're a gold mining company. You're a publicly traded gold mining company. Your beta is going to be really low because most of your risk is firm specific. But your default risk doesn't have that luxury. The banker lending to a gold mining company has to lend based on default risk. If you're a company with very low risk, that is market risk, most of your risk is firm specific, and you're a publicly traded company, it is possible for your cost of equity to be lower than the cost of debt. You're saying, what do I do that? If you're the CFO of the company, what's a logical thing to do? If your cost of equity is only 5%, and your cost of debt is 11%, what should you do? Fund your company entirely with equity. There is no, so it doesn't create any problems in terms of cost of capital, but that's the one exception. In most other companies, the cost of equity is going to be higher than the cost of debt for the reasons that we talked about. You're the last guy in line, even if you look at only the risk you cannot diversify. So as you approach your company, start by looking at the income statement. That'll tell you how much money your company can afford to borrow. Get a measure of the unlevered beta, which you already should have done. So when you see the page for Disney's unlevered beta, that's actually a replication of the page you saw in packet 1, 200 slides ago, where we built it up into 5 businesses. So it's coming into play again. With that foundation, you're ready to go. So here's the first thing I'm going to do. I'm going to take the easy half of the cost of capital calculation, where I compute the cost of equity. What do we do for the cost of equity? We start with the unlevered beta coming from the businesses you're in. And then all we do is vary the debt to equity ratio. So if you go to that page, you'll see in the first column, the debt to capital, 0 to 90%. In the second column, you see the debt to equity. I do that simply because I need the debt to equity ratio for the levered beta. But you see those numbers increase at a much higher pace. A 50% debt to capital ratio is 100% debt to equity. And the easiest way to go from one to the other is if I say you have a 50% debt to capital, you've got $50 of debt, $50 of equity. So the debt to equity is 100%. And 90% debt to capital is a 900% debt to equity ratio. Right? You have $90 of debt for everything. So the debt to equity is going to be disproportionately affected as you borrow more money, and your levered beta is based on the debt to equity ratio. And take a look at what happens to Disney's levered beta as you go from 0%, where the beta is the unlevered beta, all the way to 90%. But it's going to be what, 7.4, 7 point, I mean, what is it at 90% debt?
It is 6.23.
6.23. Think about it. If you have a beta of 6.23, you multiply the equity risk premium by that number, add the risk-free rate, your cost of equity is going to be 30, 35%. So I have 1/2 of the cost of capital table done by just taking the unlevered beta and changing the debt to equity ratio. Any questions up to that part? And that's why I want you to invest some time getting the unlevered beta for your company right for the first part of the project, because it comes into play again in this part of the project. Now let me turn to the trickier side, the cost of debt. And as I go through this process, I want you to tell me what part of this process makes it tricky. So here's my task, right? At every debt ratio, I've got to compute an interest coverage ratio. If I get an interest coverage ratio, I can go to that lookup table and get a rating. You're saying, what's the big deal? So let me take what happens to Disney when it goes from 0% debt to 10% debt. So at 0 debt, obviously, they're all equity funded. At 10% debt, to get an interest coverage ratio, what do I first need? I need to know how much dollar debt you'd need to have at 10% debt. So I start off by looking at what the value of Disney is as a firm, by taking the debt and the equity today. So today they're a mix of debt and equity. You add those numbers up. The total that I get for debt plus equity, the total value of the firm is what, 131 billion, somewhere around there? 137 billion. So that's the total value of the firm. If I decide to go to 10% debt and 90% equity, I'm going to borrow 10% of 13.7 billion. right? Everybody agree? That's 13,700 million. I need to now compute the interest expense I will have on the 13,700 million. And here's where it gets tricky. Why? Because I don't know what the interest rate is going to be. You're saying you can do the interest coverage ratio, but I can't do the interest coverage ratio until I have an interest rate. So I'm going to cheat. I'm going to use the interest rate you had at 0% debt. Let's say it's a AAA rate. Act like you can borrow money at that rate to get to 10%. I come up with an interest expense. You're saying that's going to be wrong. That's okay. I'm going to work with it as my starting point. I'm going to come up with the coverage ratio based on that interest expense. And if you turn to the next page, you'll see a lookup table that you've seen before. It's the exact same lookup table we used before. And I will tell you what the rating for Disney is at a 10% debt ratio. Now, if that rating is not AAA, I have a problem. Do you see what the problem is? The interest rate was computed as if you had a AAA rating. And now I'm telling you based on your interest expense that it's not a AAA rating. All I need to do is go back and compute the interest expense with a AA rating. And hope and pray that it doesn't slide again. The good news is I've never had to do this more than, this is like an iterative process, right? I've never had to do more than 3 iterations before I converge. What's convergence? The interest rate I use and the interest rate I come up with match. I do this at 10%. Then I go 10. You've got to start with 0 and move up, because at 0%, you can assume AAA rating because they have no debt. So start with 0, move to 10. Then once you got the rating at 10, go to 20 and use the rating you had at 10 to get the 20% started. Go through the process again. And once you got the 20%, you can go to 30. If you sat down with a piece of paper and a calculator, it's a little tedious. But in about 2 to 3 hours, you can fill in the whole table. But you don't have to. I don't know how many of you use the iteration box in Excel. But if you go to calculation options in Excel, there's this neat little box that says, allow iterations. You put a check on that box. Excel does what I just did manually, automatically. It's set for 100 iterations, because remember, I told you I've never had to do more than 3. It's overkill, but you can use the 100 iterations. It spins back and forth, it converges, moves to the next debt ratio. I'm going to send you an Excel spreadsheet that does the optimal debt ratio for a company, but nothing in that spreadsheet should be a black box. You could manually replicate every single number there, but Excel does it with a lot less tedium. So you go 0 to 10, 10 to 20, 20 to 30. There's actually an example there where I think I take you from 20% to 30% and ask you to fill in the numbers. Give it a shot, basically. And here's the starting point again. For 30% debt, you're going to take 30% of the 137 billion. That's the total amount of debt. To get your interest expense started, use the interest rate at the 20% debt, which I give you. Come up with the interest expense, the interest coverage ratio, go to the lookup table, get the rating. If it matches, you're done. If it doesn't, I've set up a second column for a second iteration. Redo the interest expense with the new interest rate. And I think because I stopped at the second column, it converges in that second column. And you can do 30, 40, 50. Again, it's not rocket science, it's just tedious. But once you're done, you're going to have synthetic ratings for Disney at every debt ratio from 0 to 90%. And once you have the synthetic ratings, because they go with default spreads, I can give you the pre-tax cost of debt for Disney at every debt ratio. Almost hope. So I've got my cost of equity from the levered beta. The levered beta reflects the increasing debt to equity ratio. I've got my cost of debt from the synthetic rating. And as I borrow more money, my rating goes. So if you turn to the next page, I should have the tables at every debt for the debt ratio, at every debt ratio from 0 to 90%. Last step, what do? Multiply the pre-tax cost of debt by 1 minus the marginal tax rate. In 2013, when I was doing this for Disney, the marginal tax rate was 36%. So you look at the cost of debt for 0%, 10%, 20%, 30%. You'd see me use the 36% marginal tax rate, which makes sense. But somewhere around 70% debt, take a look at what happens to my marginal tax rate. It starts to go down, right? Something magic. This is not a good thing, because remember, when I lower the marginal tax rate, what am I doing? I'm taking away tax benefits from your debt. So what do you think is happening around 70% debt that's causing this shift? When you multiply the pre-tax cost of debt by 1 minus the marginal tax rate, what are you implicitly assuming? That you have enough income to cover the interest expense, right? Go to the next page. I actually compute what the operating income is at 70% debt and 80% debt. At 70% debt, I think my operating income is around 10 billion, but at 70% debt, my interest expenses are 9.6 billion. Dangerously close, but I still have enough operating income to cover the interest expense. So at 70%, I get the full tax benefit. But take a look at what happens to my interest expense at 80% debt. My interest expense now becomes higher than my operating income. And the most I can deduct is my operating income. So what I'm effectively doing as the debt ratio goes past 70% is I'm being prudent and saying, look, you're borrowing money to get the tax benefits, but you don't have the income to cover it. And you can't use the rationale I use for borrowing of a bounce back, right? This is a healthy year's income. You've just borrowed way too much money. So one thing that I find troublesome about LBOs is often people in LBOs assume you get the entire tax benefit from interest expense when they're borrowing 90% of the transaction, and nobody seems to stop and check, do we have enough income to cover that interest expense? The IRS doesn't mail you a check for 36% of your interest expense. You have to have the income that covers it. So beyond 70%, the marginal tax rate decreases at 80, and it gets even lower at 90 because your interest expenses get even higher. My after-tax cost of debt now reflects two changing numbers. One is my pre-tax cost of debt is going up as I borrow more money. And the second is my tax rate starts to become lower at very high debt ratios because I lose the tax benefits. Yes?
Isn't that the zone of approaching bankruptcy?
Yeah. In fact, that's why you don't want them to go there. And now do you see why I want to lower the tax benefits? Because by lowering the tax benefits, I raise your cost of debt. And if by raising the cost of debt, I'm going to push up your cost of capital. And if you ask me how much should I borrow, I'm going to steer away from those areas because your cost of capital will actually start rising. So I'm building into the cost of capital my worries about the fact that you will not even get there.
So I guess my question is, why do we even need to plot anything beyond 70? Because would anybody want to go there?
Well, you need to do this for your company to know where to stop, right? Because for your company, it might go, you might have enough income all the way to, if you did Apple up to 90% debt, you're probably going to be able to cover up to 90% debt. So where you stop will vary depending on your company. And since you don't know until you've done it where to stop, you have to do the whole table. Now, intuitively, you might say, look, once I look at the table, I'm going to abandon all those debt ratios. My tax rate is less than, that's perfectly okay. But if you're picking the lowest cost of capital, that's going to be done for you anyway, right? Because it's going to be at a point where that's not happening. Any other questions? So if you look at that table, you see the cost of equity for Disney rising as the debt ratio goes up. The after-tax cost of debt for Disney rising as the debt ratio goes up. I have a table analogous to that XYZ widget table that I was shown in my class. But now if you ask me, why is my cost of equity, whatever it is at 40% debt, I can tell you, this is my unlevered beta, this is my debt to equity ratio. Why is my cost of debt what it is at 60% debt? I'm going to come back and say, this is the interest coverage ratio, this is a synthetic rating. Every number I can back up. I might still be wrong on those numbers, but at least have a basis for estimating numbers. And if I take those numbers and come up with a cost of capital, you see where the cost of capital is minimized for Disney? In 2013. Initially, as I go from 0 to 10, 10 to 20, 20 to 30, the cost of capital goes down, down. I think it's minimized at about a 40% debt ratio, which is unfortunate because that's two examples in a row. We have a 40% optimum. I remember I was doing this for a group of investment bankers. I won't name the bank. And these were seasoned investment bankers brought back for a re-education camp. And so there's one guy there who did not want to be there. Obviously, somebody had said, you have to go back to a re-education camp. So he was very ostentatious about the fact that he did not want to be there. He sat in the last row, put his feet up on the seat in front of him, opened up the Wall Street Journal. This was like a one-day session. And he never turned the page. That's what bugged me. I mean, what are you doing? Reading the same page for 8 hours? Until we get to this section, he puts up his hand. He said, okay, finally he has a question. What his question was? Can we safely assume that the optimal debt ratio for all companies is 40%? This is how we get into trouble, is we try to create rules of thumb, and with optimal debt ratios, you cannot safely assume that the optimal debt is 40%. In fact, the last session of this class, you're going to turn in the optimal debt ratios for your companies. Trust me, you will do it. You will get there. And I'm going to show you what the optimal debt ratios look like for your companies. You're going to see some companies with optimal debt ratios of 70 to 80%. And some companies, the optimal debt ratio is 0%. It's not 40% for every company. We'll talk about what causes the optimal to vary across companies, but the mechanics to getting to the optimal remain the same. Come up with the cost of equity based on the levered beta, the cost of debt based on the synthetic ratings to see where the cost of capital is minimized. Now, incidentally, if you prefer graphs, if you turn to the next page, you see the table for Disney shown as a graph. You see the U-shaped graph. And that's what every cost of capital in a corporate finance textbook looks like. There's a U-shaped graph for XYZ widget company. There's always a low point. But I'm going to give you a note of caution. As you do this for your company, you can sometimes get a kinky cost of capital graph. And I'm not talking about strange kinky. This is, so turn to the next page and you'll see actually a cost of capital graph I developed for Disney in 1997. That was the first edition of my book. I did exactly what I did. I haven't learned much in the last 25 years. I keep doing the same thing. By that time, I computed the optimal debt ratio for Disney. You see the graph? It's not quite a U-shaped graph, right? It goes down, down, there's a bottom, and then it starts to go up. And then it goes down again. The spreadsheet that I'm going to send you for computing the optimal has been on my website now for 20 plus years. Anybody can download it and use it. I frankly don't monitor who's using it or what they use it for. But I get aware that when people are using it because somebody sends me an email saying, did you know your spreadsheet is used? And I said, fine. Now, there's no royalty payment involved. But I'm in my office about 20 years ago. I've come back from a class, the phone rings, the actual physical phone. There was no smartphone. I pick up the phone. I don't know why I did that. And it was the first Chicago banker. First Chicago used to be an investment bank bought by JP Morgan Chase now. And he was in the middle of a client presentation. He said, I'm calling from a restroom. I said, there's a payphone in a restroom? He said, I'm in the middle of a client presentation and I've used your spreadsheet to compute the optimal debt ratio for a client. And something very embarrassing has happened. My reaction is, you're in a restroom, something very embarrassing has happened. Maybe you should call your mother, not me. He said, no, not that kind of embarrassing. I presented the graph and my client wants to know why there's a kink in the graph, very similar to the Disney cost of capital. Would you be able to answer the question, why is there a kink? Why isn't it smooth? I mean, smoother graphs are always so much easier to work with. What is it about the process by which I'm estimating cost of capital that's creating this discontinuity? Kink sounds weird, discontinuity. Yes.
The synthetic rate for
Exactly. The cost of equity changes continuously, right? Small changes in debt ratio translate immediately into a change in the levered beta. But how do I get the cost of debt? I use the interest coverage ratio and I go to the lookup table. So let's say you borrow more money, your interest coverage ratio decreases. I go to the lookup table and I end up in the same range, because remember, because these are discrete breaks. If your interest coverage ratio is between 3 and 4.5, I give you the same rating. I have no luxury there of saying you're a high AAA or a high AA or a low AA. You could end up with the same rating for a company even as you borrow more money, which is not real. In the real world, companies within the same ratings class can have different interest rates. I'm assigning the same interest rate, so that's what's causing the problem. So I explained it to him and I said, that's what's causing the problem, is the way I compute cost of debt is based on a synthetic rating, and the synthetic rating jumps or doesn't jump. And that can create this thing. This guy wouldn't let go. He said, how do I make it go away? I said, why don't you just cover that side, that part? I mean, these rolled overhead projectors, just put your hand on that and it looks fine. He wasn't satisfied with that. So I gave him two suggestions. I said, the first is, Remember this lookup table for synthetic ratings? I could, if I broke it down into finer and fine, in fact, instead of saying AA plus, had AA plus, double. The finer I break down the ratings, the less chance there is of getting stuck in the same rating size. I said, you can try that. Have 50 different synthetic ratings. It's completely synthetic. You can make up. He said, that sounds like a lot of work. I said, okay. I said, so the second question I asked him, what's your optimal debt ratio? He said, about 20%. I said, where's the kink? He said, it's 70%. So I said, what's the big deal? Who cares that there's a kink in the 70%? The optimal debt ratio is the optimal, even if there's a kink at the 70%. So what I'm trying to tell you is when you do your graph for your company, if you notice something weird happening at 70 or 80% debt, or even at 60% debt, it is happening because of this process. And as long as it's not at the optimal, it's not affecting your decision. So let me review the mechanics and make sure people get it. First step in the process, take a look, take an inventory of what your company's earnings, operating income. That's a big driver of how much you can borrow. And take a look at your unlevered beta. Is it a safe business or a risky business? Because the multiplier effect is going to kick on that. Next, compute the levered beta at every debt ratio. That's easy half because all you have to do is use that levered beta equation. If you want to do the ratings by hand, try it at least for a couple of debt ratios. That's why I wanted to try the 20 to 30% debt ratio. See if you can compute the ratings by hand. In other words, sit there with a calculator, work through 2-3 iterations until the ratings converge. When you're done, you're going to have a cost of equity and a pre-tax cost at every debt ratio. Check your interest expenses, because if your interest expenses are higher than your operating income, you start to lose tax benefits. And if that happens, adjust your tax benefits beyond that point, lower your marginal tax rate. You're pretty much done. You get a cost of equity and an after-tax cost of debt. Your cost of capital is a weighted average. Look to see where it's minimized. At least from a pure cost of capital perspective, and we'll talk about what the limits might be of doing this, you get a sense of this is where my cost of capital is minimized. But you're no longer adopting these knee-jerk attitudes of borrowing more money lowers my cost of capital. I've seen people sit there with the constant equity, cost of equity and cost of debt held constant, just changing the debt ratio. Of course, you're going to get the lowest cost of capital at 99% debt if I leave the two numbers unchanged. Question?
Couple of things. Why will that discontinuity? Can there not be a case where that occurs around where there is an optimal?
It could. Then you have a problem. Right?
Then you have to do the finer.
Then you got to do it because in the spreadsheet, I did 10% increments. No reason for that. The only reason was convenience and a recognition. It's basically the recognition that this is an estimate, right? If I told you your optimal, I could actually in the spreadsheet compute an optimal to the second decimal point. I can use the solver function. I will never do that because it gives this misleading perspective that I know your optimal debt ratio to the second decimal point. I'd much rather tell you that your optimal is around 40% than tell you it's 38.83%. If you have a kink around the optimal, it's still, as long as you're saying, look, the optimal is around 40% and that's not changing, I would let it go.
The second part was, could you do a quick recap for how we created that synthetic table?
The synthetic table came from looking at actual rated companies. Because I know the ratings of the company, I know the interest coverage ratio. Think of a gigantic Excel spreadsheet with actual rated companies. If you have the ratings of the company in the first column and the interest coverage ratio in the second, do some reverse engineering, sort the companies by rating, AAA, AA, and look at the spread within each. You have to still do some finessing, so you can't have overlapping. But that's basically how the original table was done. And it's been probably redone 5, 6, 7 times since. When I first did it, it was all US companies because those are the only rated companies I could find. Now you have far more global companies, and the S&P Capital IQ, which you have access to, gives you the rating and the interest coverage ratio. So it's pretty easy to do. Any other questions? Okay. So now I have an optimal debt ratio for Disney of 40% debt. But let's make this real. Their actual debt ratio is about 12%. At a 12% debt ratio, I think the total debt they had was 16 billion, 15 point something billion, 16 billion. think about this. I'm asking them to do something monumental, go out and borrow money, and not just borrow money, but borrow tens of billions of dollars. But let me make it even more tricky. Remember, I kept the operating income fixed as I went from 20% debt to 30% debt to 40%. And part of me saying, how can that be? I'm borrowing billions of dollars. How come my operating income doesn't change as all this money comes in? To keep the effect of the debt ratio isolated, I'm doing what's called a recapitalization. In a fancy way, let me explain what I'm assuming. You borrow 10 billion. You know what you do with the 10 billion? You use it to buy back stock or pay a dividend. In other words, you raise debt, you reduce equity. The projects you take stay exactly the same. That's why it's called a recapitalization. Why am I doing that? Because if I let you borrow money and take projects with that money, I have two effects to worry about, right? What's happening because your debt ratio is changing, and what type of projects are you taking? When you want to isolate the effect of capital structure, you have no choice but to assume a recapitalization. So here's what I'm asking Disney to do. Go out and borrow $24 billion and buy back stock or pay a special dividend. That's a huge transaction, right? And assuming you're the board of directors at Disney, I would assume you'd have some questions for me before you jumped into this huge transaction. In fact, I'll wager you have 3 questions. These are the 3 standard questions you always get when you suggest to a firm that they should borrow a lot of money and do a buyback. First question, why should we do it? Sounds like an absurd question, right? Because what's your answer going to be? If you do it, your cost of capital will decrease. I'm going to show you why that's not a very effective sales pitch and why you might want to convert that to real money so people can relate. Oh, that's why I should do it. Second question you're going to get asked is, what if something goes wrong? It's a very legitimate question every time you borrow money, either as an individual or a company. What am I talking about? I'm basing this borrowing on last year's operating income of 10 billion, right? What if something goes wrong? Doesn't even have to be COVID. It could be a recession. It could be something bad happening to Disney. What if the 10 billion becomes 5 billion? That can happen at companies. So what if something goes wrong is a test of how much buffer have you built in? How close to the edge have you brought me? And third is a very logical question. Disney is in the midst of all these big investments that it needs to make, right? Disney streaming, building new theme parks. It seems silly to borrow 24 billion, use it to buy back stock if you have all these investments you have that you need to take. So the third question is, what if instead of buying back stock, we decided to take projects instead? All fair questions, and I'm going to take them each sequentially. Let's start with the first question. Why should we do it? So I'll give you the cost of capital argument. So you're the board of directors, Disney. I'm asking you to go out and borrow 24 billion and buy back stock. I'll give you the cost of capital rationale, and you can see very quickly why it's not going to fly. Disney's current cost of capital, I think, is 7.81%. Correct me if I'm wrong, but I think that's what it is. If they go to their optimal, their cost of capital becomes 7.29%. Is that right? So by going out and borrowing $24 billion and buying back stock, you're going to lower your cost of capital about 0.5%. What's your first reaction? You want me to do what to get what? Sounds like that's not much of a payoff, 0.5% lowering of the cost of capital. And with big companies, that's exactly what you'll find. Costs of capital don't move much for mature companies. As you go to the optimal, you'll be lucky to get a 1% drop. You're more likely to get a 0.7, 0.6, 0.5%. So here's my job. I want to take that 0.5% drop in the cost of capital and make it real money. Something you can relate to. Yeah. That's what, so to get there, I need to figure out how much that'll increase the value of your company and translate into a stock price, right? Or even in dollar values. I say your value as a company will increase by 15 billion. That carries a lot more resonance than 0.5%. So the first time I tried to answer the question, I fell back on traditional valuation approaches. Remember what the cost of capital does, right? It's your discount rate to value the company. So I don't know what page we're on, I'm sorry, but no, but 56? Yeah, that's right. So the first thing I did was let me try to value Disney with the existing cost of capital and revalue it again at the new cost of capital, right? Current. So if you look at that page, I did a full-fledged valuation. I kept things simple. I used a stable growth model because I don't want to build a whole valuation model. And I said, if the cost of capital is 7.81%, the value that I get for Disney is, I think, 133 billion, whatever they are at right now. But if I move to a 7.29% cost of capital, leaving everything else unchanged, because remember, all I'm changing is the mix of debt and equity. The operating income is the same. My reinvestment is the same. I still have the same theme park, the same movies. My value as a company jumps by about $27 billion. Is that right? So somewhere around 20 something billion, the increase in value that you get?
39.
How much is it?
39.
39 billion, even more. But in doing this, I am making a couple of assumptions that trouble me. The first is, if you notice the way I got the growth rate for the companies, I took the existing market cap, the cost of capital, and I solved for the growth rate because I don't want to be doing a full-fledged. I said, I know the market price. In this case, I'm just looking at capital structure. If the market price is right, if the market cap is right, the growth rate I get is like 4.5%, which is what I ended up using for the second value. And here's the reason it troubles me. This is a perpetual growth valuation. I'm assuming a 4.5% growth rate forever in an economy where the risk-free rate is 2.75%. Remember we talked about this growth rate forever and why you've got to be careful not to set it above the growth rate of the economy. So I can't use that higher growth rate because I'm going to overstate the increase in value because that growth rate is not a growth rate forever. It's a short-term growth rate. So if I use this approach, this is exactly the problem you run into. Is you're trying to do a valuation in the middle of a capital structure analysis, and a full-fledged valuation is going to require a lot more detail. So I'm going to give you a shortcut that I think works better. One way to think about your cost of capital is this is your cost of funding your operations today. So Disney's current value is 133 billion. Their cost of capital is 7.81%. On an annual basis, their cost of funding this company is 7.81% times 133. Think of that as your financing cost. It's a little tricky because most of it is implicit. You know what I mean by implicit? That cost of equity you're not paying out, but effectively you got to make that money. So before you make this debt ratio change, your cost of financing each year is 7.81% times value of the firm. If I do make this change and go to a cost of capital of 7.29%, the same firm now is funded at a much lower annual cost. The savings I get each year. Does anybody have that page that tells me what the savings are for each year? The final number is 19 billion, but the savings each year are 866 million. So the savings on an annual basis are 866 million. That's new. If I save 866 million next year, and this is a firm that is going to last for the long term, the present value of those savings is going to be the 866 million I save each year from lowering my cost of capital, discounted back at my new cost of capital because I've now shifted to the new debt ratio, the 7.29%. My increase in value is $19 billion. I think this is a pretty conservative estimate of value because I'm taking the savings, I'm taking it as a perpetuity. Go ahead.
Why do we need to account for tax?
Well, because your cash flows are after-tax cash flows, right? So when you think about the increase in value, so I'm not sure where because when we did the cost of capital, we did an after-tax cost of debt. Right? So the tax benefits are already imbued in there. So these savings are after-tax savings, and the present value of these savings is 19 billion. Think of how much more effective that is as a sales pitch when companies borrow money than saying your cost of capital will drop by 20 basis points. For mature companies, small changes in cost of capital will translate into big changes in value. So you ask me, why should Disney do this? It's because the value as a company will increase by 19 billion. And the board of directors say, we're conservative. We don't want to do this. I'm going to say, okay, it's your company to run, but you better get in front of your shareholders and explain to them why you're willing to pay $19 billion of their value to be conservative. Conservative is not a good enough excuse for not borrowing money. But let me ask, and this is, I think, the touchy question. This is like magic, right? I changed the debt ratio, my value increased by 19 billion. Where is this increase in value coming from? It's not coming from taking better projects. I'm taking exactly the same projects.
Isn't it for the market? Or is it for the-
Well, the market alone can't explain it. This isn't even a market number. This is my estimate of value. So this is real value. I'm not even saying the price will increase. So where is the increase in value coming from? Why did my cost of capital go down when I borrowed more money?
The tax shield?
The tax shield, right? Without the tax shield, try it out with the 0% tax rate. The optimal debt ratio for the company will be 0%. You can try this for your company. It's a tax shield. This is the dark secret that no LBO guy will ever want to talk about. You see why it's a dark secret? Where is the 19 billion coming from? It's coming from taxpayers. Basically, it's a transfer of wealth from tax. I'm not saying it's illegal or immoral or unethical, but let's be quite clear. LBOs don't, for the most part, create value if all you're doing is changing the financing mix. They transfer value. You're saying, who cares? The overall economy can't get better. If all you have are LBOs driving this process, you're going to be transferring wealth from taxpayers to companies funded predominantly with debt. But there's no benefit accruing to the entire economy. So when you change debt ratios, the increase in value comes from the tax benefits, and that tax benefit is essentially taxpayers' wealth transferred to the company. Yes.
No, the board has a fiduciary duty to the.
Shareholders. That's why I said this is not illegal, it's not unethical. So the board says, we want to go out and borrow money and increase by 19 billion. I'm not going to be sitting there shaming them, saying how terrible of you made the taxpayers worse off.
But my question is, the value that we calculated is the value of the firm, including, so shouldn't the debt, I mean.
With the debt, in fact, the increase in value of equity will be exactly the same. The entire 19 billion will accrue entirely to the equity investors. It's like magic. And here's why. When you borrow money, you pay a fair market interest rate when you borrow money. There's no transfer of wealth that happens when you have debt. In fact, I'm bending over backwards. I'm setting the interest rate even on my old debt at the new level. In fact, if I wanted to really rip off bondholders, you know what I could do, right? If they're contractually left at the old rate and I borrow money at the new rate, which is much higher, I can do a secondary transfer of wealth, which is over and above the 19 billion, which makes me even better off as the equity investor. So think of this as the equity investors increase in value, assuming you try to be fair to your bondholders. You don't pull off a Nabisco on them. If you pull a Nabisco on them, you'll have an increase another 2, 3, 4 billion in value because those existing bondholders will get ripped off. But this increase in value also becomes an increase in the stock price. In fact, when we start next session, we're going to go to the mechanics of a buyback. If you decide to do this and you want to buy back your shares, what's the challenge you face? If you try to buy back your shares at the existing stock price, people will laugh at you. So almost by definition, buybacks require a premium. So the question we're going to start with is how much of a premium should you be willing to pay on your buybacks? And we're going to actually calculate what a fair premium would be where existing shareholders are not left holding the bag. So we'll start with that next session, but I want you to go back today, lots of little details. So go back and review the notes for today. And I'm sorry about the slides. I have no idea what's going on, but Mac to PC PowerPoint is God only knows. So hopefully by next session, I'll figure it out. Thank you.
So we can. Oh, nice. Sarasota.